Welcome to the Global Commerce Academy, your trusted platform for 100% free CMA USA classes. Whether you're just starting your journey in management accounting or looking to sharpen your expertise, you've come to the right place. Our mission is to make high-quality CMA education accessible to everyone, everywhere, at absolutely no cost. Here, you'll find a supportive community of learners, expert instructors, and a wealth of resources designed to help you succeed in your CMA USA exams and beyond. In this session, we'll be diving into Chapter 3, Forecasting Techniques, which is part of Section B Planning, Budgeting, and Forecasting from the CMA USA 2025 syllabus. This chapter is a cornerstone for anyone aiming to excel in the field of management accounting. Forecasting is not just about predicting numbers, it's about understanding the story behind the data and making informed decisions that drive business success. We'll break down complex concepts into easy-to-understand lessons, ensuring you grasp both the theory and its real-world applications. Throughout this chapter, you'll discover the practical tools every CMA must master to predict future business performance. We'll start with the basics, like simple trend analysis, and gradually move to more advanced techniques such as regression models and time series analysis. You'll learn how to interpret financial data, identify patterns, and apply forecasting methods to real business scenarios. By the end of this session, you'll be equipped with the knowledge and confidence to tackle forecasting questions on your exam and use these skills in your professional career. Let's begin this exciting journey into the world of forecasting. Forecasting is the process of using historical data and assumptions to predict future outcomes, such as revenue, expenses, cash flow, or demand. In the CMA role, forecasting helps in planning future operations, making resource decisions, reducing business uncertainty, and preparing for risks and opportunities. Effective forecasting means turning data into insights, and insight into action. There are two primary categories: qualitative forecasting, which is based on judgment, opinion, or experience, and is used when historical data is limited. Common methods include expert opinion, market research, and the Delphi technique. Then, there's quantitative forecasting, which uses mathematical models and data, is based on past performance, and is more objective and measurable. As a CMA, you'll often combine both to build reliable projections. Time series forecasting methods are powerful tools that help businesses, economists, and researchers predict future values by analyzing patterns in historical data. These methods are especially useful when data points are collected or recorded at regular intervals over time, such as daily stock prices, monthly sales figures, or yearly economic indicators. By examining how data has changed in the past, time series forecasting allows organizations to make informed decisions, anticipate trends, and plan for the future with greater confidence. The core idea behind these methods is that historical patterns, such as trends, cycles, and seasonal effects, can provide valuable clues about what might happen next. There are several key techniques used in time series forecasting. The first is trend analysis. This technique focuses on identifying the long-term direction in which data is moving. For example, if a company's sales have been steadily increasing over the past 5 years, trend analysis can help project how sales might continue to grow in the future. This method is particularly useful for understanding the overall trajectory of a business or market, and it helps organizations set realistic long-term goals. Trend analysis can also reveal when a business might need to adapt its strategy if the trend begins to shift. Another widely used method is the moving average. This technique involves calculating the average value of data points over a specific period, such as a week, month, or quarter, to smooth out short-term fluctuations and highlight longer-term trends. By filtering out random noise, moving averages make it easier to spot underlying patterns in the data. This approach is especially helpful for short-term planning, such as inventory management or sales forecasting, where sudden spikes or drops can obscure the true direction of the data. Moving averages can be simple or weighted, depending on whether all data points are treated equally or more recent data is given greater importance. Exponential smoothing is another important technique in time series forecasting. Unlike the moving average, exponential smoothing assigns more weight to recent observations, making it highly responsive to recent changes in the data. This method is ideal for situations where the most current data is believed to be more relevant for predicting the future, such as rapidly changing markets or industries affected by sudden events. Exponential smoothing can quickly adapt to new trends or shifts, providing timely insights for decision-makers who need to respond to changing conditions. It's important to note that all these time series forecasting models operate under the assumption that the future will follow similar patterns to the past. This assumption works well in stable environments where external factors remain relatively constant. However, in times of rapid change or unexpected events, these models may need to be adjusted or combined with other forecasting approaches. By understanding the strengths and limitations of each method, businesses and analysts can choose the right tool for their specific forecasting needs and make more accurate predictions about what lies ahead. Causal models look at relationships between variables, like how sales depend on advertising or season. The most common technique is regression analysis. This method identifies how one or more independent variables affect a dependent variable. For example, you might forecast sales using price and ad spend. CMAs use regression to model cause and effect and justify strategic decisions with data. Forecasting is powerful but not perfect. Common limitations include unpredictable events like pandemics or economic shocks, incomplete or outdated data, and, human bias and assumptions. Sometimes models can be overfitted and just don't generalize well. The CMA's job is to balance precision with practicality and always include a margin of uncertainty. There's no one-size-fits-all approach. You should choose based on the availability of historical data, the business environment, whether it's stable or volatile, the time horizon, whether it's short-term or long-term, the required accuracy level, and of course, the cost-benefit of complexity. For example, use qualitative methods in new markets and quantitative models in mature operations. Imagine you're a CMA in a retail company. You use exponential smoothing to forecast weekly demand, apply regression to analyze how ad spend affects online sales, and use qualitative inputs from store managers during a product launch. This combination creates a balanced, intelligent forecast, one that drives performance and profitability. Let's take a moment to summarize everything we've covered in this chapter. As we wrap up, it's important to reflect on the key concepts and practical insights you've gained about forecasting techniques. Whether you're new to the world of finance or looking to sharpen your skills as a CMA, understanding these methods is essential for your professional journey. Forecasting techniques are absolutely critical for strategic planning and financial decision-making. In today's fast-paced business environment, organizations rely on accurate forecasts to set realistic goals, allocate resources efficiently, and anticipate future challenges. As a finance professional, your ability to interpret data and predict trends can make a significant difference in your company's success. We explored a range of forecasting methods, from simple averages and moving averages to more advanced techniques like regression analysis and time series modeling. Each method has its strengths and limitations, and knowing when to apply each one is a valuable skill. Remember, the right forecasting tool can help you identify patterns, minimize risks, and make informed decisions that drive business growth. As a CMA, your job is to choose the most appropriate tool for the situation at hand. This means considering the data available, the complexity of the problem, and the specific goals of your organization. By mastering these techniques, you'll be better equipped to provide actionable insights and support your team's strategic objectives. This was Chapter 3, Forecasting Techniques, from the Planning, Budgeting, and Forecasting module of the CMA USA 2025 curriculum. We hope this chapter has given you a solid foundation in the principles and applications of forecasting and inspired you to continue learning and growing in your career. If you found this video helpful, don't forget to subscribe to the Global Commerce Academy. Here you'll find all CMA chapters explained in a way that's 100% free, easy to understand, and designed to help you succeed on your very first attempt. Our mission is to make high-quality education accessible to everyone, no matter where you are in your learning journey. Join our growing community of learners and future finance leaders. With the right knowledge, dedication, and support, you can achieve your CMA goals and unlock exciting new opportunities in the world of business and finance. Thanks for watching, and we look forward to seeing you in the next chapter.